Hello, everyone, and welcome to the July 20th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get right into those hot button market issues, so let's just get started. Let's start here. We've got Iran and U.S. conflict back in the headlines, and oil crept back up above $80. You probably saw a little bit of respite in gas prices if as we were coming in the prior weeks, as oil went from well over 100 to then down to into the low 70s. And I think it actually went into the 60s for a bit. But now we're back above 80. Honestly, we didn't see as much of a respite from gas prices, considering the dramatic decline in oil. We didn't see as much of a respite in gas prices as people would probably anticipate given that level of correction, because refining and time that it takes to do these kinds of things. So we did have a bit of a respite, but now it's starting to creep its way back up. It's not at the all-time highs, but the gas prices again are becoming, or at least have been, a sustained problem for the better part of a few months for consumers overall, and especially again that middle to lower tier consumer. That's just much more of a pinch for them. Now, I don't think oil prices are rising rapidly. Again, we just crept back over 80. We're certainly not looking like the initial U.S.-Iran conflict issues where we spiked pretty quickly. We were much more worried, it seemed at that time, at least compared to now, about the Strait of Hormuz being closed for a very long period of time and stifling off oil production and oil supply. We don't seem as concerned by it now, but this rising conflict does create some greater tension. So it's something we have to watch out for. Again, from our perspective, there isn't a ton to do here when we have this. It's something more for us to monitor than to create actions based upon these right now. Certainly, we're not at an area where I would be suggesting any type of either reduction in risk from your current level of risk or increasing as such. I think your equilibrium level of risk is absolutely fine right now. I don't think you need to adjust based upon slightly changing oil prices. Turning to number two, IBM came out with a warning before their earnings and said numbers just weren't going to be very good. And really what they said was the AI deployments are having such an aggressive component of spend that it's taking from their software business. And IBM, it's kind of legacy software. They offer middleware services. They offer a lot of enterprise related stuff. So business to business type of things, business solutions, not a lot of consumer facing software for IBM. But it does give me an indication that, AI money has to come from somewhere. And I've talked about this before. And I think, from tech budgets and IT professionals that I hear talk about things, there's basically two levels of spend right now. It's artificial intelligence and cybersecurity to protect yourself from the artificial intelligence deployments that are rapidly deploying to get at your system. So those two elements are basically sucking the wind out of everything else out there right now, and everything else is secondary from a spend perspective. So if your software has deployments of artificial intelligence that they're putting within their software system, then there's a chance, do you consider that AI spend or do you consider that software spend? Who knows? But if you don't do that and you're sitting in this middle ground, I think you are very susceptible to at least a pause in spending at this point right now, because everything else is being swallowed up by those two entities. And I don't see an avenue right now where enterprises are really extending that out much more, because the pricing is getting so negative. Pricing of chips has accelerated aggressively to where you're seeing it in personal computers. You're seeing that and everywhere, which is going to affect the pricing of the things that they're going to want to do from other sides. And so pricing is having an influence, but just the dedication of spend to those other initiatives is really kind of sucking the wind out of it. And I'm wondering if we're going to start hearing a little bit more about this in this coming earnings season. I haven't heard a lot yet, but not a lot of these companies have reported as of yet. So that starts this week and into next week. So it'll be very interesting to watch if IBM is just a one-off, which again, from my perspective, for an IBM for a long period of time, I haven't owned the stock forever because I've just thought that they're constantly a market share loser. And so from that, I just think that there's better companies to buy that are actually gaining market share over a longer period of time. So I haven't owned IBM, but IBM did do very successfully for quite some time here before really having a difficult time last week based upon that early warning announcement. Turning to number three, which is more earnings, I'm calling it nervous about the sugar high. And this relates a little bit to what I was just talking about with IBM. We're starting to see the big, earnings is expected to grow over 20%. I think we actually will do that this quarter, which is phenomenal. It's the second quarter of 20% plus growth. That hasn't happened for quite some time. So really, really, really strong earnings right now. So our current picture is absolutely one of health and quality earnings and really good earnings growth, which is usually a great backdrop for the S&P 500. Why I say I'm nervous a little bit about the sugar high here is the components that are driving the extended earnings growth. So one is oil companies, which are reporting numbers from $100 oil basically right now. But now they're in more of a, 70, again, $80 range, starting to creep back up, but certainly not at the levels where they were just printing money at 110 and 120, right? Or I don't think we hit 120, but even in the 100 plus range, it's just extremely profitable for oil companies. And they're going to have earnings that are going to reflect that in the numbers this quarter. The other side of that are the semiconductor chips. And semiconductor chips, as I just talked about before, have just exploded from pricing, from basically supply constraints, because everybody's trying to do artificial intelligence deployments. And so the demand for chips has been extraordinarily high, which has caused the pricing to skyrocket. Now, the problem with skyrocketing prices is at the outset, during the time of doing it, it's phenomenal, right? You're just printing money again. But you have two issues, is that usually that doesn't last forever. And then you have a demand problem that leads to then a collapsing price. Remember, semiconductors over a long history, recent history has been very different, but over a long history have been about the most cyclical things you can have, in the effect of you have these massive booms and you have these massive busts where oversupply and overbuild and overdemand, and people are buying things that they don't actually need just to make sure they have the inventory. And then all of a sudden it completely turns around where they're saying, well, I have too much and now I'm not buying anything for the next couple of quarters, and their earnings just come crashing down. It may not happen. This may be the difference one. This may be something different this time. But that's what I'm calling the sugar high here a little bit, is saying, both the oil prices, that's a sugar high that's really already starting to wane its way off. And then the pricing sugar high from the semiconductor chips is something that over an extended period of time could work its way down really aggressively as well. So I'm a little worried here from that perspective about the go forward earnings, is that can the other businesses, because really the quote unquote hyperscalers, your Metas, your Amazons, your Alphabets, your Microsofts, these companies, their earnings are really depressed at this point right now because they're spending so much money, right? They're spending everything they can to deploy on artificial intelligence. And revenue is good in there. Don't get me wrong. It's not like revenue is terrible, but the spend is far eclipsing the revenue that they achieve because they're hoping that will scale itself over a longer period of time. Well, if you have a little disruption in that curve and all of a sudden they're saying, well, the revenue is not matching and we want to actually earn some money because our stockholders are starting to punish us and starting to get a little antsy. So we're not going to spend as much. Well, that's going to go right to the chipset companies. And those chipset companies, again, could have massively different earnings profiles going forward. So from my side, it's just the sugar high. Again, I'm not saying that this is going to collapse. I'm saying these are the kinds of things that I need to pay attention to, because from an earnings perspective, that could have a pretty significant headwind against earnings, and the rest of the companies might not be able to make up that difference. So something to watch out for. And lastly, in turning to number four, more on the personal side here, I watched the World Cup final. It was, again, it's the thing that non-soccer fans like myself, I'm not a huge soccer, that I watched more of the World Cup than I probably watched in soccer for the past 5 years. But I enjoyed the World Cup a lot. Well, one of the things I didn't enjoy about the final was, 0-0 for 106 minutes isn't my favorite thing in the world, but I understand that, for people who watch this, that's not uncommon. So I totally get that. What I didn't like and what I haven't liked about Super Bowls recently, and I mean, honestly, this has been around for a while, is that the crowd seemed very different from the crowds of the earlier World Cup stages, where you had a massive home or home influence, or people were traveling to these games and really just super into it. I mean, tears in the stands, living and dying with every corner kick and all that stuff, which was just phenomenal. It was so fun to watch that. But I did not feel that in the last game at all, because I think honestly a lot of that was corporate influenced, right? You had, celebrity spottings left, right, and center. You had the president there. You had all of this stuff, which is creating, again, a high demand for it and a high pricing activity for it, but it's much more corporate feeling of that last contest, where I didn't feel like there was as much of that living and dying. Now, when we got close to the end, it absolutely did, but just that interim period, and plus the fact that the halftime show was longer than it usually was, you still have the 2 breaks. The fun part of me for soccer has always been the running time, is that you kind of know when you're in and out, you're not Americanizing the sport and really taking the last 2 minutes, taking 3 hours. You kind of just go, which I like a lot about that as being a differentiator. But we kind of sanitized that a little bit with the long halftime and the 2 water breaks and those kinds of things. So it wasn't my favorite one, but my overall World Cup experience, again, I relatively enjoyed it. From a person who does not know much about the sport, I enjoyed watching it. It was an incredible experience to see some of these athletes, world-class athletes, really taking it to and really being part of their country and really kind of living and dying with every move. That was awesome. Could just use a little less of the corporate championships, both in the Super Bowl and in the World Cup final. So that's all I have this week. Tune in next week. We'll have our next top button topics. But until then, thank you very much. Take care of yourselves.